My name is Andrew Stotts of the Global Equity Valuation Competition. Really excited to see the work of so many talented young people. Our next contestant is Apurva, who's going to be presenting TVS Motors. So that's an exciting one. I haven't covered this company, so I'm interested. And just like you listening and viewing, if you got questions, make sure you put them in the chat and let's bring her in. All right. Apurva,
Hi,
how are you
Andrew.
doing?
I'm great. How are you?
I am wonderful, and I'm learning, and I'm interested to see the different companies that are being presented.
Yep.
So I'm going to pull yours up on the screen, which I can see it now, and I'm going to turn it over to you. So I'm going to exit, and then as soon as I exit, then you can start. So I'm exiting now. You can start now.
All right. Thank you. So, hello everyone. My name is Apurva Dharam, and this is my equity analysis on the company TVS Motor, as Andrew just introduced. So, this is the contradiction that I want to present today. TVS Motor Company is one of the best run companies in Indian manufacturing. Strong management, strong EV positioning, growing exports, a 100-year legacy. And yet, my recommendation is sell with a target price of around 2000 rupees. Not because the business is weak, but because even great businesses become bad stocks when expectations run too far ahead of reality. And that is exactly what I believe has happened with TVS Motor at around rupees 3500 market price. So TVS Motor is India's third largest two-wheeler company and the fourth largest globally. Its portfolio spans across motorcycles, scooters, EVs, three-wheelers, and premium bikes through Norton Motorcycles, which it acquired in the UK. Operationally, this has been an exceptional business. Between FY22 and FY25, revenue compounded above 20% annually, while profits compounded nearly 45%. Margins improved consistently, exports expanded to over 80 countries, and the iQube became one of India's leading electric scooters. So the debate here is not about the business quality. The debate is entirely about the price. At the current market price, TVS trades at 45 times its actual FY26 earnings. For context, its competitor Bajaj Auto, which actually has higher operating margins, trades at nearly half that multiple. So the market is already pricing TVS as a near perfect growth story. And my thesis for this is simple. The expectations embedded in the stock price are far higher than what the business can realistically deliver over the next decade. So, moving forward with the industry growth and risks, to be completely fair, TVS just posted its strongest year ever. Their FY26 revenue reached up to 47,000 crore rupees, up 30%. Operating profit grew 40%. Their EV sales grew 33% for the full year and 51% in quarter four alone. Three-wheeler sales also grew 63%, and these are the numbers that I just got from their recent press release. And these are genuinely exceptional numbers. So why sell? Because the very next month, that is April 2026, growth slowed to just 7%. And management themselves have guided single digit volume growth for FY27 given the current market conditions and inflation. So FY26 may represent peak growth, but the stock price at 3,500 is priced as if that peak becomes the new normal forever. And that is the core problem. Now, revenue growth has already slowed from 27% in FY23 to 20% to 14% in FY25. At the same time, competition from Hero Motocorp, Bajaj Auto, Ola Electric, and Ather Energy is also intensifying. EV margins also remain lower than internal combustion engine margins, while capex requirements continue rising aggressively. So the long term business story is still intact, but the valuation already assumes perfection. And this is where the numbers become decisive. I valued TVS using an FCFF based DCF model, focusing on the operating business first and adjusting the debt separately afterward because of their varying debt levels. So, my assumptions were intentionally reasonable and not bearish because revenue growth gradually slowing over time, EBITDA margins expanding from roughly 13% to 14%, capex normalizing as EV investments mature, and a terminal growth rate which is in line with the India's long-term nominal GDP growth. So I used a WACC of around 11.5%. That's based on the India's risk-free rate of 10-year GSEC bond, and an equity risk premium of 6.5% and an industry appropriate beta of 0.9. So even with these relative favorable assumptions, the forward DCF still suggests meaningful downside from the current price. But the more important point or insight came from the reverse DCF. Instead of asking what TVS is worth, I asked what growth is the current stock price already assuming? And the answer was surprising. The market is effectively pricing in around 20% revenue growth every year for the next decade. And importantly, even the recent EBITDA beats are not fully flowing through to the earnings because higher depreciation and interest costs from rising capex are starting to structurally pressure their profits after tax and the free cash flow. So TVS has never sustained that level of growth for such a long period, even during the post-COVID premiumization cycle, initial EV boom happening simultaneously. And there's another important point. Even if the bull case fully plays out, you would be taking 10 years of business risk while earning returns comparable to a risk-free asset, and that from an investing perspective does not make sense. So to conclude, that TVS Motor is a highly business with a high quality business with strong management, strong products, strong long term positioning. But great businesses are not always great investments. Both forward DCF, reverse DCF point to the same conclusion, that the current stock price already embeds near perfect execution, and therefore my recommendation is sell with a target price of approximately 2,000 rupees. Thank you.
Great. Can you go back to the front page, the first page?
Yep.
And let's talk about this share price. So I think you've indexed the share price there. Maybe you can just talk briefly about what's going on. We have seen the share price looks like coming down a little bit, but what do you expect as far as movement in the share price?
So the recent movement, because they have recently said for April or the FY27 quarter 1 and quarter 2, for the growth to be in single digit, I think the share price would go down a bit. Maybe I think for 3,000 up to 3,000 rupees per share. And for if we consider the bull case, if the EV is really growing because of the current market conditions, the fuel price rising, and the people moving towards EV, then yes, it might grow, but I don't think that it would sustain uh, at 3,500 or 3,600 at for the rest 10 years or so.
And what is the catalyst? I mean, we see many companies that can stay expensive,
Right.
because people like them, or they got a lot of investors in it. What's the catalyst that's going to bring this down?
So I feel that along with the rise of EV, there's also rise for the competitors that are there. Competitors like Bajaj Auto and Honda as well as Hero Motocorp. So Bajaj and Hero are really really popular in India, as well as their distribution is amazing. Hero's distribution is amazing, especially in rural areas. And if we talk about two wheelers specifically, rural areas are they carry 40 to 50% of revenue for these companies, right? So I feel that competition would be really high. Another fear or another factor would be incentives, because auto industry, especially EVs, are highly dependent on the government incentives. A PLI scheme, that is production linked incentive scheme, is a subsidy by government of India. So these kind of schemes, also the consumer demand, would it lower, it would definitely lower for ICE, given the current market conditions. So I think these catalysts are there.
And a lot of, if you were running a business, you would be in a situation where you would try to take on new projects that had higher returns, not lower returns.
Yeah.
For the industry, it seems like they go into EVs and many of them make a lower return. I believe that that's what you said.
Yeah.
Is
The
that?
current-
Yep.
yeah.
Go ahead. Explain that.
Right. So the current EV margins are relatively lower than the ICE internal combustion engine margins. I think they are 6 to 8%, and ICE margins are 13 to 14%. So, in order for EV margins to go up, if they go up by, let's say, 15 to 16%, or even 13 to 14% by the next 2 or 3 years, only then would you see a growth in EV segment. And I think because currently they have mentioned in their release that EV EBITDA margins for electric vehicles, they are going through a break even. So even if it goes through a break even, the higher capex cost that they are having, especially if the battery costs and the imports that EVs need, the electronic batteries, that would offset the margins, I think.
Okay. And one last quick question is just, should we avoid the industry as a whole or just this company?
I would say just this company. I feel that there are other companies that can have, even if, I mean, in terms of EVs, we should look forward to other companies. And even though I haven't studied them in
Mhm.
terms of their numbers, I think EV does have a future. So it won't be a harm to study other companies and then make a decision.
Great. So how does it feel to complete this competition?
It feels the pressure is off my mind. And a little bit about myself. I am not from finance background. I'm actually completing my engineering and computer science this year. And I just got an interest in finance 2 years back. And then I started following markets. I started doing mutual funds. And then right now I'm a CFA level 1 candidate. So this was a really great opportunity for me to apply the theoretical knowledge that I learned through the subjects like equity or corporate issuers to practical use.
Mhm.
So I would really want to thank you for giving me this opportunity.
Yep. Well, wonderful. And the world of finance is such an amazing world where you can build an incredible career. And hopefully we're going to see you in the Valuation Masterclass Bootcamp. So
Thank you
excellent.
so much.
Yes. Okay. I'm going to see you in the Slack channel. Well done. And we're going to move on.
Bye. Thank
All right.
you.
Yep. Wow. That was Apurva. And she presented on TVS Motors, another tough competitor out there. These guys, everybody's doing a great job. The Global Equity Valuation Competition is open to anybody, as you've just seen, including electrical engineers or others that are engineers, accountants, and others. It's sponsored by Valuation Masterclass and Koifin. So hopefully you'll join the next one. My name is Andrew Stotz, and I'll see you